So with the juvenile focus today, Equitable Life has long been a part of the juvenile market. We like to see the diversification across our entire par fund. And so that's really at the root of why we do focus on not only the corporate market, which has been a focus for us over the last little bit, but also that juvenile market, that family market has become certainly a big one for us over the last little bit. And as a mutual, that is one of the focuses. That flagship product is our par whole life. And what I wanted to take you through today was an interesting approach that we've had some success over the last couple of years. And once we go through, I'll show you why that is, but particularly in the juvenile market, why this works so well. And it's called the all-inclusive package. And so what I want you to think of this, and yeah, you can liken it to your vacation when you go away, kind of that all-inclusive approach. When you go away on an all-inclusive vacation, you're paying up front for everything. And that's kind of what I want you to have at the back of your mind as we go through this. Now, we will touch on some of the benefits of juvenile life insurance overall and why individuals would want to see that. But I think it's important that you know that there is an option other than your standard solution when you're talking about juvenile life insurance. So, of course, my name is David Hutchison, Director of Sales over on the insurance side at Equitable, but we do have a great team across the country. So if we're going through, as Don mentioned, ask questions. And if you're not sure who your director is on the life side for Equitable in your area, let me know and we'll make sure you're all taken care of. So without any further delay here, let's get into the presentation. So there's the disclaimer, just letting you know that any tax or advice here, I'm not a tax professional. So let's make sure we're well aware of that. But I will touch on some things that are helpful. Now, the typical insurance case that you'll be going through on a regular basis, probably almost for most of you, 100% of the time, is that pay as you go. So that's that month to month, year to year. Back in the day, I guess we used to have quarterly or semi-annually, but now it's monthly or annual is your focus. So that's your typical pay as you go life insurance. Each year, each month that elapses, that client is paying for this policy, and by maybe the end of 20 years, 10 years, or maybe it's a life pay, that policy is now paid off. What we're going to be talking today about is a bit of a different approach to that. It's called the all-inclusive. And like that all-inclusive vacation, what we're doing is we're essentially paying for that policy up front. And so what we're doing is coupling a term certain annuity to prearrange the payment, whether it's a 20 pay. In this case, we're going to focus on the 20 pay. But if you wanted to do a life or a 10 pay, you could also structure it in a different way like that. But particularly, it works most effectively on those limited pay options. And for us on the juvenile market, the 20 pay is certainly an area that stands out for us. So that's really how we're getting that all-inclusive approach. Is a client might have a bundle that they're looking to put forward to a life insurance plan. Unfortunately, we can't put it all into the plan as one lump sum anymore. Most of you will know that there were some changes a number of years back that now we're unable to really jam that policy full of a single deposit. Maybe there are some options like that out there, but particularly when you're looking across the industry, you're unable to really put it all in at once. So how can we do that? How can we still find a way to help that client out that's got the money to leave a legacy and set up prearranging payments, but we don't have the ability to put it all in at once? The term certain annuity is a great tool to do that. Now, for those that haven't come across what a term certain annuity is it's certainly a lump sum investment. So like an annuity, it's that lump sum investment that's going in and provides a guaranteed income for a specified period. So for instance, we've got that grandparent that has a lump sum payment that wants to set up a legacy product. Again, we can't put it all into the policy at once. If we set up a 10 pay, or in this case, a 20 pay, what we can do is have that income every year going to pay that annual premium on the life insurance plan, and it does so for that specified period of time. And I'll talk about how these are structured, but in a 20 pay scenario, what we'll be doing is paying the first initial premium and then setting up a term certain annuity to pay the remaining 19. And again, I'll show you how that all works. There's no worry about the market fluctuation or changes in interest rates. Right now is a very strong period of time for annuities. The rates are very strong, so clients can get a little extra bang for their buck. And it provides preferential treatment on the tax side with the prescribed taxation. Creditor protection is available possibly in some situations. It avoids probate, but most importantly for your client, it provides them not only with the peace of mind that knowing that this is all set up and taken care of, but in a lot of cases, it may save them money over the course of that 20-year period that they'll be paying for this policy. And we'll talk about that. So the benefits going forward, they're numerous. Again, the premiums are paid without impacting their day-to-day lives. So specifically, when we're talking about grandparents, they don't want to have to worry about those payments each and every year, every month. It's important to make sure that we're setting something up that's easy for them, but it does work for parents too. They've got the money to set aside. This may be an approach that, again, as opposed to putting it somewhere else and having to worry about getting the payment out of that investment, sending it to the insurance company, this might be a good way to couple with that whole life insurance. Of course, the 20-pay premium option on the whole life plan allows this policy to be taken care of in 20 years. It will continue to grow. It will continue to garner value, but the parents or grandparents who have taken this out for that child know that after 20 years guaranteed, that policy is now paid up. They don't have to worry about any future payments unless there are other riders attached to it, and we'll talk about that as well. Of course, that tax advantage growth is continuously growing inside that policy. So whether it's the cash value that continues to grow, or more importantly, a death benefit that when paid out would be tax-free to the beneficiary, this is a great plan because you're setting this up at a lower age, which means you're locking in lower rates for those children. The guaranteed cash value is a nice to have, but of course we look more at the total cash value because dividends, although not guaranteed, have been very successful, especially on the Equitable side since 1936 when the par fund started. We didn't miss any. And of course, the peace of mind knowing that a client has now taken that lump sum, set up this policy. They don't need to worry about tracking down payments. And for grandparents, unfortunately, it's a situation where oftentimes they're concerned about making sure that policy is paid for. There is no burden on the next generation if for some reason they do pass prematurely. This way, we set it up in a way that if something were to happen, we've got a successor annuitant and a contingent owner to take over that policy ownership as well. Now, for you as the advisor, there's a couple of different benefits as well. Not only is it great persistency, because now you know that policy is locked up and taken care of, so that's important, but you are also getting commission on both of those products. So it's important for you to know that there are benefits for the client. Of course, that's paramount, but for you as the advisor, you're getting 2 sales, you're locking up that persistency, and more importantly, you're helping that client who's got a lump sum willing to take care of that policy, but also the insured, being a juvenile, now has coverage for life and knows that it's taken care of as well. When you're looking through this, regardless of the type of policy that you're going to set up, whether it is this all-inclusive or it is that typical pay-as-you-go, month to month, year to year, the market is important, and the guarantee for you is that you've got clients all around, whether it's a parent or a grandparent in your existing book of business, or if you're a new advisor starting out, the ability to reach out to new prospects and talk to them about this is immense because everybody's got children somewhere in their lives, whether it's themselves, they might know somebody, and the kids or grandkids are the most important thing in those individuals' lives. So if you find somebody that's wanting to provide a child with permanent life insurance, they want to prearrange funding for that life policy, and that's oftentimes it is going to be grandparents that you will seek out for this type of opportunity, but I have seen parents take advantage of it as well, simply because they want to know this is done, taken care of, and there's something that will grow. And oftentimes those parents themselves have either talked to somebody who has seen the value of this, or they themselves have had a policy taken out by their parents and something set up so that when they reached 20 years of age, 30, 40, later on in their lifetimes, they've got something already there, regardless of how much it is or the value that's inside of it. And of course, maybe it's something where the parents want to have access for the children to be able to take advantage of that later on. Maybe it's a down payment for a home or purchasing a car. Maybe it's even using it for post-secondary or buying a business. All very important uses for that cash value, and it will be there. Now, there's a good question from the chat room. Most of my clients use RESPs for education, not life insurance. What we always stress is this. This should not be a replacement for an RESP. This would be more something that couples along with it. This is a tool that would go along with that particular vantage point. Now, what we're saying is this is more of a product that, although yes, can be used for post-secondary, and some clients do choose to use it for that. I think this is something that when you position it as for the child's life, not on their life, parents and grandparents tend to see that, okay, yes, we may have a cash value that builds up there that could be used for post-secondary, but it should be beyond that. This will be something that can be used later on in life, as I mentioned, down payment on a home, perhaps. Maybe it's helping to finance a business later on. So the RESP angle is exactly being used as it should in this case. If you're using that for education, please continue to do so. I think that this is more of a sidecar to that if you're looking at options down the road for these children. So this is not a replacement. This is more of a complement to that strategy. So I'm glad to hear that advisors out there are continuing to use RESPs to fund post-secondary. But again, that's for one specific reason. What are they going to do later on? And when we talk about how to set this up with certain riders, particularly the flexible guaranteed insurability option for later on in life, there's a lot of different safety nets that this type of policy provides, in addition to the access to the cash, of course, that could be very valuable as we move forward. Now, the process is going to be key because when we set this up, we've got a very particular way we need this to go. And the beauty of it is this is a strategy that we at Equitable Life promote. We want to be able to make it easy, not only for you as the advisor to do business, but also on the client's end to make sure they're well taken care of. So the policy is going to be outlined, set up, and when it's ready to issue and settle, we're actually going to settle that policy first. So the initial payment, whether it's, in this case, it's going to be annual, and regardless of what the 20 pay, 10 pay, life pay, whatever it is, we're going to pay that initial premium from the client to settle the policy. And now we have all the information we need to go ahead and then set up the term certain annuity. So initial premium to settle, then we set up the term certain annuity because there is a process. There's important points to clarify because once we have that whole life set up, now when we submit the term certain annuity, and if you do that with Equitable, it's an automatic payment every year coming from the annuity. The income payment will then pay that whole life premium to make sure that it's paid every year. The reason why we do it this way is twofold. We know that now the policy's settled. We know exactly the amount of premium because it does have to be precise to the penny. And we also know the issue date. And that's important because that issue date the following year, after we've settled that policy, is now going to become the first income date for that payment from the annuity to make sure we're satisfying and we'll pay that second year of annual premium. Now, important points to clarify when we do this with the clients. We want to make sure that any changes after issue with the whole life may affect those future premiums. So again, if we're dropping riders off or changing coverages, we want to make sure that clients know that if there's a change, that could be affected. Similarly, if we add that flexible guaranteed insurability option, those payments continue after the 20 years, depending on the age that we've chosen for that last option date, because those options continue to be paid for until they're used or passed up. So make sure that we know that. And of course, the term certain annuity, once it's locked in, it's exactly that. It's locked in. Cannot be changed to cover future changes in premium. So that's why we want to settle the policy. If there's any ratings, riders that need to be added, any of that that's done at issue or right before, that's all in place before we set up the term certain annuity and can handle it that way. Now, we've got a good question from the chat. If the child uses the cash value for education, will the removal of cash be treated as a loan with applicable interest? Good question, and that does depend on the method, essentially, of how that cash is being accessed. Now, it's important to note that any access of value from within the policy could, not in all cases, but could be subject to taxation. So it would depend, Edwin, on how those funds are being accessed. Because if it's taken as a true withdrawal, if it's, again, being coming out of the policy, there could be a tax consequence. And if it's being taken as a loan, it also could be taken as a tax consequence, depending on what the adjusted cost basis is, how much is being taken. There's a lot of different pieces that go into it. The main thing to note is whenever you're taking a withdrawal or a loan from the policy, and yes, if we're using it for post-secondary education purposes or to fund a down payment on a home, those are all points in which when we're taking them out, they could lead to something that could generate a tax consequence. So always be prepared for that. And it is important to note that, and our team will tell you if the advisor themselves is assisting with the client or the client themselves is applying for a loan or a withdrawal, we'll be able to tell them up front if that particular occurrence is going to generate a tax consequence and what approximately that will be. So good question here. Many of my high net clients take premiums out of their TFSA accounts. They are already in a high tax bracket and do not wish to have the clawback of OAS. Absolutely. And this isn't for everybody. This is for those clients that prefer to have it set up, forget it, and save a bit of money doing it. I'll show you how that works because it's important that all clients do qualify for this. So good point on that. Again, they may have other vehicles, or you as the advisor may have other vehicles that you'd wish and rather have the client set these up for and take payments out of that. Absolutely perfect to do. We just wanted to show you how advisors, now that the annuity rates are at a solid point, are using not only this method to save the client's money, but again, peace of mind, because as I mentioned, those payments are automatic. They're coming from the term certain annuity. If it's with Equitable, that's paid automatically to the life side and taken care of. And now that I look at the next question, does the client get paid any interest on the annuity? They're not paid any interest on the annuity, but because there is an interest built in, their actual annuity payment for the annuity itself, that single deposit that they're making, is actually going to be discounted because of the interest. So they're not being paid any interest per se, but that is factored in when we do determine what that annual income to pay the policy needs to be. So they will benefit from some interest, and there will be a tax piece that's identified on there. But great questions, because that is important to note. There is that's part of the benefit of setting it up this way, is that the interest that's involved can help them save some money on that particular transaction. So just circling back to this, important points to clarify with the client: any changes cannot be made on the annuity, and there could be changes on the payment afterwards. Again, if the 20 years run up and there's a flexible guaranteed insurability option rider that's still there, or a CI plan that's still there, those are all things that may continue past the 20 years. We can always look at offsetting at that point, though, because oftentimes those payments are not as important to cover with a separate payment, may be able to be offset within the policy. Now, other considerations, of course, the premiums may be required after the term certainty. I touched on that. Term certain annuity expires. The interest portion of the annuity is subject to taxation, as I just mentioned, and the dividends aren't guaranteed. So particularly when we're talking about those life pay policies and we might be looking at a potential offset, this is where, if we're looking at offsets, those aren't guaranteed. And that's exactly why a parent or a grandparent would look at a 20 pay or a 10 pay that are guaranteed, to know that after 10 years or 20 years, those policies are guaranteed to be done. They're guaranteed to be paid for. If you're looking at a life pay with an offset, the issue is that because the dividends aren't guaranteed, although we've never missed one, they aren't guaranteed and could affect that offset if for some reason something changes. Now, as I mentioned earlier, we at Equitable Life are really committed to this and helping advisors find ways to make it easier to do business. That's why we include an introduction or a checklist, so that if you do come across one of these opportunities, you can work with both your life director and your savings and retirement director, not only to set up the whole life, but also set up the term certain annuity. But there's a checklist to help take you through the process. As I mentioned, the key is we're settling that whole life policy, we're putting that in place, and then after the fact, then we're taking a look, setting up that term certain annuity. And because we've done so after that policy's issued, what do we know? If you remember back, we will know the exact premium. We know the exact issue date of that whole life policy, so that we can tell the term certain annuity or put on there what our desired first income date is. But we also now have a policy number that when we're submitting the term certain annuity application, we can make a note that this term certain annuity, the income that's going to be paid out annually from it, is going to be funding policy 800-333-333. We know that, for example, that policy now is going to be funded by that term certain annuity, and we can move forward going through. Now, some of the best ways to take a look at these options and make sure that you've seen the power of this is to take a look at a case study. So that's what we're going to go through now. And as I mentioned, it doesn't always need to be grandparents taking this type of scenario or opportunity out on their grandkids, but it is one that's common, particularly when we're using that term certain annuity, because oftentimes they have that money left behind. They've got that money there that they want to put into something to leave a legacy. And oftentimes, the benefit of doing it this way is because they know now that there's, again, peace of mind that it's going to be paid for. And they have it set up that if something were to happen to them, there isn't a burden to pay going forward. We have this term certain annuity. We name a successor annuitant. That person should match the contingent owner on the whole life plan. So maybe if it's a grandparent taking it out, one of the parents is either the successor annuitant and contingent owner, or both, however you want to set that up. I think it's important to make sure that every client is aware when we're setting this up. It's a very particular part of the process. So in this case, we're going to talk about Victoria. She's a female, age 67, the grandparent in this case, and she wants to set something up for her grandson, Paul. Now, Paul is age 4, male. Victoria has identified to the advisor that there is a $25,000 amount that she would like to contribute to a solution, permanent life insurance in this case, on her grandson, Paul. So as the advisor taking a look at this, you know now that we're unable to really deposit all at once into a life insurance plan and say, here we go, set this up and forget it, and that's it. We can't put it all into the life insurance policy. But what we can do is help Victoria, in 2 separate steps, set up not only the life insurance plan, but now this term certain annuity to ensure that it's paid for each and every year. When we're going through this, this is a look at our software desktop version. We also have for our whole life an online version that's very important that you could go through. What we want to do in this case is we want to find out how we're going to be able to help Victoria for this. Now, what the advisor did was discuss, okay, what's an ideal amount to take a look at? And just to sidetrack for a second, when you're setting up a whole life insurance plan on a juvenile, this can oftentimes go one of 2 ways. There might be, and in this case, Victoria had a number in mind, a coverage amount, a desired coverage amount. She wanted at least $100,000 for Paul. That's what she wanted to start with. But oftentimes when we're talking to grandparents or parents for that matter, we might come across a particular budget amount. And when you take a look at this particular screenshot, you'll see in the middle, beside the coverage amount, there's a solve for face amount button. This becomes your friend in these situations where instead of getting a desired face amount, you now have a desired premium or budget amount that the clients want to focus on. And whether it's annual or monthly, you can just change that, go into that solve for button, enter the amount that you're focusing on, whether it's $100 a month or $1,000 a year, and find out not only what type of coverage that will buy or the amount, but they may want to add an accelerator deposit option on top of that, which will then help. An accelerator deposit option is what we call EDO. It's also known as ADO or plus premium out there in the industry. That's essentially a way to overfund this plan above and beyond the cost of insurance. We'll touch on that in a second, but just in case you're coming across these plans more often as an advisor looking to build your business, this is a great way to take a look and either start with a desired coverage amount or take a look at a desired premium amount, which will help as well. Now, there's a good question from the chat regarding when are we able to apply for non-smoker rates instead of juvenile rates? Now, that's a great question, and it's actually a pretty good segue to the next piece. So I'm going to touch on that very quickly, and I will get to that. But what we've done now is we've changed our juvenile plans. So going forward, up until about February of last year of 2023, what we did was we issued as non-smoker rates, which was great. So it wasn't a blended juvenile rate, it was a true non-smoker rate. But at age 18, if either we didn't have a declaration submitted that said this child was a non-smoker, or we hadn't heard from anybody at all, or the child themselves did have to declare as a smoker on that declaration, the rates would go up to a smoker rate at age 18. So you had 2 opportunities, or technically 3, because we would send out a declaration at age 16. If we didn't hear back on that one, we'd send one at age 17. And if we didn't hear back on that one, we'd send a final one at age 18. And if we got something back that said they were a non-smoker, excellent. The rates just continued as non-smoker, and there was no need to do anything beyond that. What we're talking about here is there a time to apply for non-smoker rates as opposed to a juvenile rate? Well, after February of 2023, what we did was we changed our permanent plans so that all juvenile plans are now issued unless that child does declare as a smoker up front. So if they're a 16-year-old that's already vaping or smoking, of course that child has to be issued with smoker rates. But if we're talking about a 4-year-old that is looking to get a new policy issued, we're going to issue that policy as non-smoker rates, and there's no longer a declaration that's needed along the way. So good question, because that now isn't a factor. However, the question is always asked, what about those previous plans? Well, they're not grandfathered into this new rule. They will still be required to complete the declaration at either age 16, 17, or 18 in order to then get the non-smoker rates to continue. So new plans going forward, no need for a declaration or to declare non-smoker rates at age 18. But for the previous ones issued before February of 2023, those will still need to do that. So great question. Thanks for asking that. Here's a poll for you. Take a look. Make sure you're answering that. If you're licensed in Quebec and need that credit, make sure you're going along. So back to our case study here. Victoria, again, 67-year-old grandmother looking to take out a policy for Paul, who's 4. We looked at 100,000. What we've got now is an annual premium rate of $1,451 even. That will continue as the annual premium as we move forward. So now we've got two things. We've got this set up, 20 pay for Paul, paid up additions as the dividend option. We're going to use, in this case, the wealth accumulator, because what Victoria wanted to see was early cash values. Perhaps this is being used for that post-secondary. Typically, we'll see most of these juvenile options done in the estate builder because it's more of a long-term focus. But if we have something that's more of a short-term time window that we're looking at using the cash value potentially for, that's where the wealth accumulator would come in. And in this case, that's where we would see this being used, because she wanted Paul to be able to, in 15 years, to be able to access that cash value. It's around 15 to 20 years where the estate builder starts to take off. So keep that in mind as you're moving forward, because we do get a lot of questions about that as well. So now we've established the option. We want to do 100,000, 20 pay wealth accumulator with paid up additions, and we want Victoria to be able to fund that with a term certain annuity. But before we get to the term certain annuity, got to establish the life insurance. So the life insurance policy owner is also going to be the annuitant. In this case, that's Victoria. She's the one taking out the annuity, so she will be the owner of the policy to start. The life insurance contingent owner is also going to be the annuity beneficiary or the successor annuitant. So that should be most likely one of the parents of this child in this case, because Paul's 4 years old. If something were to happen to Victoria along the way, we want to make sure she's well taken care of. That policy will continue not only to be paid for, but there's not going to be any tax consequences shifting hands with ownership. Special instructions on the application, though, when the life app is coming in, we're going to actually notate that although the client is going to pay that initial annual premium, the remainder of these 19 years in this case are going to be funded by a term certain annuity. Now, the annuity is not set up yet, so we don't have an annuity number, nothing like that to begin with, but we are going to tell our new business department to set this up so that after the initial payment, we're not looking for pre-authorized debit details. We're not going to be receiving checks. Those payments are going to come automatically as income from that term certain annuity. And of course, the signed illustration that will be submitted with the Life app would also be automatic if you were doing an online easy complete application as well. So very simple process, submitting the life insurance app. But here, the key is to note that it's going to be settled and then paid for by a term certain annuity. So again, pay the annual premium. That can be taken out of that, in this case, lump sum payment that Victoria has. Remember, she's got $25,000 sitting there. That initial $1,451 is going to be taken from that. The remainder will be used for that term certain annuity, but we're going to settle that first annual premium to make sure the policy's in place. Now we've got that. We've got the policy put out. It's settled. It's issued, ready to go. We now know the exact issue date. We know the exact amount of premium. And now we know that we need to set up a term certain annuity for 19 years. So when we go in to establish the term certain annuity quote, we're going to run the duration, for 19 years. The female is going to be based on age 67. Usually we're going to do this right after the juvenile plan is set up. It's going to be prescribed tax status. The owner is going to be the annuitant. So in this case, Victoria. We now know that first payment date. that whole life anniversary. So now we're going to take a look. We've got that set up. The income frequency is going to be annual. And the income amount, if you think back to the illustration, the life illustration, was $1,451. It must match the premium exactly. So if there was 33 cents added on there, what we're not going to do is put in $1,452. Or we're not going to go in and say, let's just make it an even $1,451. We want that annual income to be exactly whatever the annual premium is. So again, in this case, it's $1,451, but if there were a couple of pennies on there, we add those in. What this quote is going to tell us that in order to fund 19 years of $1,451, what Victoria will have to pay as a single deposit into this term certain annuity is going to be $20,167.90. So now when we submit the term certain annuity application, we can put in there that here, this is the term certain annuity, 19 years to begin on this date for this exact amount. But we also have a key piece of information that we can add. What is the life policy number that we can now put in there to identify to our savings and retirement team that this is going to automatically fund policy 800-333-333 every year for the next 19 years. These are the special instructions you want to add. This keeps everybody on the same page. And as you can see, because it's going to be automated from the perspective of Equitable Life, the client doesn't have to worry about extracting payment from another investment vehicle and then submitting it to Equitable to pay for that policy. It's all done automatically and very seamlessly if it's set up correctly. So now the payment for the annuity comes in. Victoria, remember, has already paid $1,451 to settle that first annual payment. She's now going to set up the term certain annuity with that single premium that we talked about of $20,167.90. This could be scalable. It might be smaller, it might be more, but this is what she's going to be paid for. And now we've set this up so that Paul will later on in life, he can access that cash value. As I mentioned, when this one was set up, it was done so as a wealth accumulator. So we were focusing on the cash value in the first 15 to 20 years. So at age 19, if Paul wanted to access that cash value, he could for post-secondary. And at age 24, now that 20 years has elapsed, two things have happened. That policy is now paid for 20 years, and the term certain annuity that was set up for 19 years, because Victoria paid year one separately, is now done as well. Now, what we want to do is take a look at these case studies and how they can help you. So if you want to look further beyond that, it's very important to take a look at some of the marketing materials we've got. These solutions are available as marketing pieces. So whether it's something you're going to present to your clients to show them a real life scenario, or more importantly, it's something that you as the advisor want to have as a reference point, very invaluable pieces to take a look at because they will help you as you move along. Now, before I move on to the life and health bundle, I think it's important to talk about some of the nuances of juvenile life insurance. And when we position life insurance for juveniles, I did touch on it earlier. I think it's important that when you're talking to parents and grandparents about this, that you highlight the fact that, again, it's on the life of the child. No, that's not the way we want to position it. It's for the life of the child. It's not insurance just to cover them in case something happens. Now, of course, it is there in the event of a tragedy, but I think it's important for parents and grandparents to get past that morbid rejection or objection, saying that this is something that they don't want to talk about. You know, there's nothing that's going to happen to my child. And of course, we hope that there isn't. But in the event that something does, yes, there will be coverage there to help out. Maybe those parents have to take leave from work to help grieve, set up, pay for final expenses, whatever it is. More importantly, it's for the life of the child. We're looking out 40, 50, 60 years to make sure that there's enough of a nest egg there that not only helps them from a cash value perspective, but also is there to help the next generation when we talk about funding for those policies. So that's, I think, one of the biggest objections that you're going to find is when you're talking to parents and grandparents, they don't see the value of putting life insurance on a child now because what needs could they possibly have? What you need to stress is this: we're building for the future, not only from a value perspective, but we're also trying to cover the insurability of these kids, especially when you talk about the features that are available. And one of those features is the critical illness application that could be added onto this particular coverage. And now that we offer both term to 75, term to 100 options with a 20 pay option on top of that. So these T75 and T100 CI coverages can be for years and years and years. I mean, if we did it on Paul, who's a 4-year-old, and you got a T75, he'll have 71 years of critical illness coverage, but it can be paid off in 20 years and can be part of the solution. So really creating that life and health bundle. And when you talk about CI for juveniles, our plan is very competitive. Not only does it offer the 26 covered conditions for adults, the 26 recently added being acquired brain injury, which today is certainly very important. But in addition to that, we're adding the 8 non-life-threatening conditions that are covered, in which if we pay out one of those are paid out maximum of 15% or 50,000, or what you can then have is the 5 additional coverages that are available for juveniles on top of that particular coverage. So the 26 covered conditions for adults, the 8 non-life threatening, and now the 5 conditions that drop off at age 25 for juveniles. And it's a really comprehensive package now that you've designed for the kids with the life insurance and with the CI bundle really coming together to offer that equi-living critical illness that, again, can be paid off in 20 years. And you can use this term certain annuity to help fund that as well. So something to keep in mind. Will the slides be available afterwards? Of course. We can certainly provide a copy of the slides if wanted, and we can most importantly provide a copy of those marketing pieces. They are available on Equinet, but I understand it's a lot easier if we just package together and say, for juvenile focus, here's the pieces you want to take a look at. And particularly, I think one that's going to happen or really help advisors as they move forward into this market is that introduction and checklist, because it will help you with the structuring and will really take you through the process as well. And finally, when you're quoting these, I think it's important to take a look at some of the best practices out there. And one of those being the ability to position it properly to clients when you're going through. And I think one of the ways to do that is by taking a look and talking to the clients about what the values look like. And when we're going through that, that's going to look at different things on different illustrations. And when you take a look at the illustrations themselves, regardless of the company, you're looking at 20 years in, you're looking at age 65, maybe it's age 85 for life expectancy. One particular trick that we did get as a best practice from some of our best advisors out there that are working in this marketing space for juveniles is what they'll do is, yes, they will focus on those key ages. But the first one they go through is looking at the age of the parents who belong to this child and highlighting the values in that age. So for instance, if Victoria was taking out a policy on Paul as part of that case study that we just went through, and Paul's parents were 35 years old, or one of them was 35, one of them was 30, what you could do is highlight the age of 35, highlight the age of 30, and say, look at these values. If somebody had taken out a policy for you when these parents, and you're talking to the parents now, and taken this out for you all those years ago, similar to what you're considering for Paul now, these are the values that would have been built up originally. That's very important to have. And I think that's where you really help to paint the picture for clients going forward. And now that you can actually encompass an idea, a new angle to help grandparents, and as I mentioned, sometimes parents, by way of that term certain annuity to make sure that those policies are being taken care of, paid for ahead of time. And now you as the advisor not only has provided that peace of mind, but now you've built a fence around those clients as well. And as you'll see, it was actually less expensive for Victoria in our case study to pay for it using that term certain annuity and that initial annual premium of $14.51 than it was to do it each and every year for 20 years, because she actually saved some money by way of that interest payment that was going through. So very important. And I see some pieces. I will go through one more particular example, I guess, from best practices before I get going, but I do appreciate the comments from the chat as well. And we will get you copies of the slides as well as the marketing pieces. One thing I don't think that advisors are utilizing enough, in addition to the CI, rider on top of these whole life coverages is the flexible guaranteed insurability benefit. So one of the reasons why Equitable Life has become a real leader in the juvenile space is the premiums are competitive. I'm not saying that we're going to be the least expensive, but we certainly will be competitive. Where I think we really do earn a leg up and get some interest out there is because of the values. When we're talking about a mutual company, we're focused on those 40, 50, 60 years out beyond 1 year, 1 quarter. That some of the shareholder companies need to focus on to be able to honor those requirements. But we're focused on a longer term duration. We want to see what the growth will be. So the values will be strong. But the other reason why we garner a lot of attention in the juvenile space is because of that flexible guaranteed insurability benefit. And here's why I don't want you to overlook it. And I've had advisors come to me and say, well, what's the likelihood that they'll use it? The reason why it's important is this. They may not have to use it. We really hope that they don't have to use it. But to talk about the insurance opportunities with clients, that's exactly what we're trying to protect against, the what ifs. By setting up a juvenile policy, we're talking about long-term growth, not only for their generation, but for the next. But why not also lock in their insurability by adding a flexible guaranteed insurability option? And with the Equitable Life plans, regardless of the coverage amount that you're starting with, so if it's 25,000, 50,000, even 100,000 of coverage, what you have is if you exercise all options for the full amount, you can have up to 5 option dates or ages later on in life that can be for a total additional coverage amount of $500,000. So for instance, I'll give you an example of a case I worked on last week. $25,000, newborn child, the advisor was the grandparent, wanted to get this set up. But the key was not just the 25,000 to get the whole life started, but it was the flexible guaranteed insurability option because we now have 5 additional ages later on in life and up to $500,000 to use if in some time down the road that child is uninsurable. Maybe they've decided to take up dangerous or hazardous sports in their teens or early 20s. Maybe they've decided to smoke. Maybe they've decided to experiment with drugs. Whatever it is, there's a lot of opportunity, and you talk to underwriters about it, for insurability to change in those early to late teen years. That's one of the key ages. There's a lot of influence that happens at those ages. So this way we lock in their insurability because that initial option date, if you do decide to take out this rider, is at age 21. Now the minimum for each option date is 25,000. The max is 250,000. Remember, as I mentioned, you have up to 5 ages to a total of $500,000 to use. So you can spread it out over 2 or 3 option dates. You can spread it out over 5. A typical configuration I see is this. The initial option date needs to be at age 21. So I'll oftentimes have advisors talking to me saying, well, I don't know how eager that child at age 21 or the need, what that will be like at age 21. So I'm going to put a lower piece at that age. So 25,000, for instance. Now at age 30 or 35, there's going to be a greater need for insurance. Maybe they've now gotten married. Maybe they've purchased a home. What I'll do is I'll add a $225,000 option at age 30 or 35. And these option dates go up until age 45. So then now I've used 250,000. I still have up to $250,000 left to use. I can use at age 40 or 45 a $250,000 option. So over 3 option dates, I've now got $500,000 of coverage that if this child needs to use it later on in life, they can access it. The key is, there's 2 things. The first key is, of course, this is a non-medical transaction. They just, when that anniversary comes up of that option date, they can apply for a separate coverage. This would be in addition to the base whole life that was originally started. But the other key with Equitable is not only the vast amount that you can use this for, but it's also the fact that it can be used for permanent or for term plans. So keep that in mind. Again, these option dates can be used later on in life, and advisors will say, well, if they're healthy, they won't use it. Exactly. If they're healthy, they may not need to use it. Maybe they need $1 million of coverage. Maybe they need 5 million at age 40. Great. Help them get that. Work with the next generation. However, the problem arises if their health changes somewhere along the line, they can't get coverage. For under $10 a month, you were able to get them an option that allows them up to $500,000 later in life without needing to go through a medical. I think that's important. And for you as advisors, you should really be looking at the entire picture. So that includes the CI, but most importantly, it does include, if you're setting up a whole life plan, talk about the options that are available on the permanent side as far as those flexible guaranteed insurability options. So anywhere from 15 days old to age 17 with us is considered a juvenile plan. And I think for you, when you're out in the market, remember, you're trying to find ways to work with not only existing clients, but non-existent clients that you haven't worked with yet. What a great way to prospect new people, talking about the options. Have you heard what you can do by setting up a policy? Locking in a man's or woman's policy at boys or girls rates is a great way to position whole life insurance on a child, but not to mention the fact that there's going to be growth inside of it. And if you couple it with a term certain annuity, you've got a new angle now to help out those clients that have lump sum amounts, that want peace of mind to know it's paid for, but also want to save a bit. And by setting it up as an annuity today, you'll have that option. Now, before I forget, just for all those that are watching this, Equitable Life is announcing our new dividend scale that will take effect on July the 1st. So watch for that. Very important as a flagship product for us as a mutual. That dividend scale, although not the be all end all for determining where to go, where to place your business. I do think it's important that, especially as a mutual, you see that we're working to help those par policy holders, whether it's a juvenile policy or it's an adult policy. They're all very important, and that is an important role to play. So for those of you that are looking for an opportunity to build your business, find policies that are a lot easier to work with, and talk about new opportunities, look at your existing block, target that next generation. Older investment clients have children. This is your way to segue. If you're an investment advisor, talk about segueing and talking about insuring their grandchildren. That'll be a great way. And usually these cases are approved pretty quickly as well. So
Dave, a couple more questions have come up if you want to look in the Q&A, just about
sure.
When I convert, if I take that term option, is that convertible later on then to permanent insurance?
Yeah, absolutely. Yeah.
And what's the minimum amount of term insurance that I can get as that option?
That's a great point, because at Equitable, our minimum term insurance amount is actually 50,000. So when you're exercising that option date, even if you have a $100,000, $200,000 option, don't forget the client doesn't have to use it all. They can use only a portion of it. And if for some reason the option date happens to just be for 50,000, they can absolutely use that for term, lock in some more insurability, and don't have to go through medical. So great question there.
And Dave, if I'm setting up my policy, as an example, we've got some people on the line here that are infinite banking specialists, and if I'm setting it up to collateralize that policy to take a loan, how quickly and what's your process for depositing it directly to my bank account from Equitable Life?
It's very quick, and I'm glad you asked that, because that's part of the innovation that's been going on for probably a last number of years, but it's really been executed well. Clients who have access to it's called client access portal, can go in and actually request a loan right online, right from their own access. You as the advisor, importantly, will be notified that this is happening. There will also be, if there is a tax consequence, that will be notified as well. And to take it a step further, advisors who want to be involved in the process also have the same access. If they were to go into Equinet, our advisor portal, they can request a loan quickly. EFT within a couple of days is generally the standard turnaround time, between 3 and 5 business days to get a loan. Very quick. And as you mentioned, Don, we're seeing a lot of these lately. So it was prudent for us to find a way to make this a lot easier for clients and for advisors to help them out too.
I guess the next question that sets up is, like, obviously in some cases there would be a tax consequence, and they are notified that there will be a tax consequence before they confirm that they want to borrow against that policy. Is that what you're telling me?
Yep,
and then the advisor gets a simultaneous email saying that scenario.
Yep, so that's the case.
Yeah, they can counsel that client to say they might want to take a little less to avoid the tax consequence if that child is not someone old enough to take possession of the policy, because I could change the beneficiary at 18, transfer it to the child at a zero tax position probably, and not affect any of those tax consequences. The next thing is, can you just alliterate a little bit about, if I do take a loan against the policy and I pay it back within 12 months, What impact does that have on the tax consequence?
Yeah, that's a good point, because by paying it back before we need to issue a tax slip, that
Yeah.
would be your way of essentially eliminating the taxable situation, and we can then move forward. And we do see that a lot. As you've
Mhm.
probably heard, anybody who's got access to social media, we see a lot of that strategy out there. And one of them is paying back that loan that you do take. And interesting to note, since we're on the topic, our loan rate currently, and I know going forward, is going to remain at 6.5%. So very competitive out there as compared not only to other lenders, but in the industry. So not only are you getting the benefit of, if you decide to keep that loan going, a low interest rate, but should you pay it back in time, we won't need to issue that tax slip. And it's a great way for you to focus on being your own banker, essentially, in that infinite banking concept.
And is that tax slip issued at the end of year or at policy anniversary?
End of year.
Yeah.
End of year.
I just
So
want to
that's
just
a
wanted
very
to clarify that, because if you did take it out December 31st or December 1st, you've got 31 days to put it back. If you take it out January 1st, you've got 364 days to put it back. So just wanted to
right.
clarify that.
Timing is key and everything. And also when you're taking out policy loans, for sure. These policies can be corporately owned, but what you'd want to do is, it's really going to come down to the structure. And I was meeting with our tax and estate planner, Brian McNulty, yesterday, and he did touch on the fact that sometimes these policies are corporately owned, but it really does come down to the structure. So it's a case by case. But to answer the question, yes, they can be. It just depends on what's most effective. We did talk about the loan being paid back, so thanks for that, Don. And the loan rate, 6.5%, is the policy loan rate direct from borrowing. Yes, from Equitable directly. If you're taking it from us, the one other thing I just wanted to touch on, because this came up yesterday, is when you take a loan from Equitable directly using your policy, don't forget that that loan is actually not coming from your policy directly. We're collateralizing your policy with the par fund. So the money's actually coming from the par fund. Your policy continues to grow. So it's a great option. And whether you're somebody at Equitable who's loaning against that or not taking the loan, you will benefit, because 10 to 12% of our par fund performance is actually made up of policy loans right now. So whether you're one of our lenders who has a policy and is not actually taking a loan, or you're somebody that is actively using that, you still do benefit, and great way to take advantage of those policies.
All right. Well, thanks for your time today, David. Maybe in our next session, what I would like to see, and we didn't get into it today, is some comparisons between the one thing that I do a lot, and I know the people that we've referred to on the line so far, deposit option is a big thing. So we really didn't get into the actual numerical impact of deposit option. I think when you're doing a wealth situation, that's such a valuable asset that it's pretty hard to ignore it. And I think a lot of people that really don't understand whole life don't use it at all. So
Right.
they're using a plain vanilla, the old plain vanilla whole life policy, and not really a turbocharged whole life policy. So maybe next time that's what we'll get into.
I think that's key, and you're right, because when we do have those solving for budget, solving for $100 a month, $200 a month, and we use that maximum EDO amount, you'd be surprised how much that does enhance and really accelerate the growth. Even if it's $25 a month on a juvenile, it makes a huge impact in 20 years. So absolutely, that should be a focus. And yeah, I know that's an area you like.
And we've got one more question from Don Turnbull, and it's about the tax consequence of the owner of the policy. Just remember that the tax consequence is to the owner of the policy. So if the policy is transferred at any time, it has to be after age 18, I guess, is what the law would tell us, but in your policies. But after 18, if it's transferred to the child, the tax consequence goes to the child. I own my kids' policies until last year, I transferred the ownership to them as a tax-free rollover to them, obviously, and then any loans against those policies are tax consequence to the owner of the policy, which now is my child. So
that's the key, and that's why when these are set up, depending on the age of the child, we want to make sure that, especially when grandparents are doing it, and in this term certain annuity option, we want to make sure that successor annuitant matches the contingent owner.
right.
But as long as one of those contingent owners is a son or daughter of that person who's owning it originally, you're right. No tax consequence, very smooth that way. Yep.
All right, I think we've wrapped it up. And some people have commented they'd like to see that deposit option webinar. So maybe we'll chat about that later.
Sounds great.
All right, have a good one, Dave. And thanks everybody for joining us today. Have a great day out there and continue selling. Have fun.
Thanks again.
See you later, Dave.